The strong demand for apartment investment in Los Angeles is driven by several factors, some historic and some a ramification of the recovery and the recession. Historically, Los Angeles is one of the largest apartment markets. We have 10 million inhabitants, of which 50% to 60% are renters, so between 5 to 6 million people are apartment renters or home renters in LA, which is an enormous demand. Secondly, the Los Angeles market provides a diversity in its submarkets so that you can have urban infill, you can have some value-add markets, you can have core markets, and you can have some B markets. So it provides a greater opportunity to apartment investors. Currently, there haven't been many apartments on the market. Apartment transactions in 2009 and 2010 have been very, very few and far between. We saw an increase in 2011 to approximately $2.9 billion worth of transactions, but that's very low when you compare it to the average $3.6 billion transaction volume of 2003, 4, and 5, and very far below the $5.7 billion transaction volume of 2007. So we're improving, but there's more room for growth. Today, in the recovery that we're seeing, we're starting to see increased rent growth in certain markets. On average in Los Angeles, we'll probably see 3 to 5% rent growth. We're forecasting between 5 and 7% for 2012 and 2013. And once we see a continued recovery of the economy and decrease in unemployment, we're likely to see double-digit rent growth in those years. So that's something that investors have been waiting for and are looking forward to seeing. In 2011, on average, we saw cap rates hover between 4 and 4.25%, with some rumored transactions saying they're dipping into the high 3.9%, and people are thinking that that's going to be a bubble. But if we look at it on the grand scheme of things, today's rents after 2008, 2009, and 2010 are 10 to 15% lower than they were at the peak. So if you buy something today, you're buying it at a discount of 10 to 15%, and if that rent growth comes through, in 2 years, you'll have something that's worth 20% more than what you paid for it today. So it's a great value. Apartment investment in Los Angeles in 2012 and 13 will continue, I anticipate, at an even more aggressive rate than we saw in 2011. The reasons for the increased appetite for apartment product in Los Angeles is that rent growth will be even more accelerated than we saw in 2011. We're likely to see 5 to 7% rent growth in 2012. Additionally, the stage that Los Angeles is in its economic recovery, we're kind of lagging behind a number of other gateway cities and metropolitans. So we haven't yet hit our full stride. We're still on the upswing, which bodes well for Los Angeles in general. We're going to start to see an increase in rent growth in 2013, 2014, 2015. So at the stage that we are in right now, there's more recovery left, and after the recovery, there's going to be continued expansion. So investors are not late to the party. They can buy apartments in 2012 and 2013 and still feel comfortable about their investments, that they'll see appreciation. The type of investors that are currently buying apartments in Los Angeles are representative of every investor class. In 2009 and 2010, REITs and investment funds may have been the most aggressive, but soon, with the price of debt becoming so compelling, we saw every investor class represented. The playing field's been leveled. We've seen private investors come in and pay top dollar from some downtown assets. We've also recently seen the REITs become more active, acquiring a variety of different properties in downtown Los Angeles. So the market is firing on all cylinders, and every investor class is currently a player. The Los Angeles apartment market is currently registering 96.5 to 97% occupancy, which tends to indicate that it is undersupplied. that trend is being reflected by apartment developers' increased appetite in apartment development land. Since October of 2010, we've seen apartment investors actively pursuing development opportunities in core urban infill markets such as downtown Los Angeles, Hollywood, Mid-Wilshire, Santa Monica, Long Beach, and we're starting to see that in Orange County as well. In 2010, we were in the market with 12th and Figueroa, a downtown land parcel. Apartment investors who threw their hat in the ring on that deal were looking at return on costs untrended of 6 to 6.2%. Today, apartment investors are underwriting return on costs between 5.5 and 5.75. Some are going as low as 5%, but we haven't seen those actually materialize in offers or closings. So the appetite for apartment land has become that much more competitive that investors have decreased their return on cost by almost 100 basis points.